Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Hey, M&A Unplugged community. This is your host, Domenic Rinaldi. So happy to have Tad Render back on the show. Tad is the head of the transaction services practice at Miller Cooper, the 10th largest accounting firm in Chicago. Tad and I spent some time talking about business financials and valuations during this COVID period and how buyers and sellers can best navigate this chaotic period. We also discussed PPP loans, the impact they are having on M&A transactions, and how buyers and sellers can protect themselves. Tad and his team are M&A experts, and Tad is a wealth of knowledge. You won't want to miss this episode. Before we get into the interview, please head over to K2 Advisor and take our free seller or buyer assessment. These assessments will help you understand how ready you really are for an acquisition or sale. And being prepared is critical to ensuring that you maximize returns and minimize risks. Thank you for being here. Hey, M&A Unplugged community. We have back with us Tad Render, who is the head of the transaction services practice at Miller Cooper, which is a local Chicago CPA firm. Tad, welcome.
Thank you, Domenic. Appreciate it.
You are one busy guy right now, I would imagine.
It has been hectic.
Hey, we got a lot to cover. We want to cover what's happening with folks and their financials and what you're seeing. And we want to touch on PPP and what's happening there. Why don't we start at a high level, though? And what are you seeing in the marketplace right now from a financial perspective? And, you know, what's happening with valuations? What are the banks saying? Give us your view of that.
Sure. We're really seeing kind of a wide range of responses to the coronavirus pandemic. I think you'd be hard pressed to find a business not impacted, whether it's positive or negative from the pandemic. We thought in our practice, transaction flow was going to drop off a cliff. It really hasn't. People are still out there looking. There are still a lot of motivated sellers. A lot of deals are getting put on pause. In a lot of situations, the earnings of the underlying business have deteriorated over the last couple of months, and both buyers and lenders are eager to see what the rebound effect is. And unfortunately, that rebound hasn't occurred for a lot of the industries hit hardest by the pandemic.
Yeah, we're seeing the same thing, and we don't really know when that rebound is going to happen. And will it be fall? Will it be the end of the year? Will it be next year? We've got a lot of sellers coming to us and asking us, how do they value their business, during this period of time? And it's really hard, right? Because if they were impacted and they haven't rebounded, you're really sort of in limbo state, right?
You really are. And unless a seller wants to take a significant seller note or shift a significant portion of the consideration to an earnout, they may be well advised to put a pause on the process and let that rebound occur. When we look to do our quality of earnings analysis, and the lender is looking at the historical earnings, they want to see a trailing 12-month period. Well, if we're including March through June in that TTM, the numbers may not look the best. So to the extent we can get a rebound effect and get the earnings back up, or accurately quantify some of the impacts to the P&L that the pandemic's had on the business, it may be best served to hold off a bit.
Yeah, I mean, because you're still faced with the issue of what does rebound look like, right? And unless you have a picture to that, it's going to be hard to probably get a negotiation done with a buyer, unless, like you said, there's a significant earnout or seller note. And even then, what are the metrics? Because you don't know what a rebound could look like and in what time frame.
Right, and there's lender considerations involved on how much leverage the business can support.
Yeah.
at the current earnings level.
Yeah. And it's interesting, Tad, I know you and I were talking, we have almost the opposite situation happening for some of the businesses that we're seeing that are going gangbusters, where they actually have been a benefactor of COVID, where maybe they've doubled or tripled in size, and they're looking for valuations maybe at that new level, but it's probably hard to know if that's the new normal for them, and it may not be. Is the answer?
For sure. We're helping a buyer evaluate a landscape contractor, and they've had their record April, record May, and likely record June in the history of the company. Everyone's staying home, no one's traveling. Instead of taking that vacation, they want to redo the backyard, and he can't keep up with volume. So the backlog's growing. So it's going to be a great 2020 for this contractor. I don't know if that's going to continue into 2021. So we're having discussions on valuation in that situation.
And what's where are you leaning there? Like, it's going to be hard for a buyer to bite off that they should be valuing trailing 12 months, knowing that the business is taking off because of COVID.
Right. In that situation, I think the end result is going to be an earn-out mechanism that'll be paid out over 2021 and 2022 if the business continues to perform how it has over the last 3 months.
Is the baseline valuation, though, based on historicals, do you think? And then the earn-out
because in this situation, the negotiations began kind of prior to any impact from coronavirus. Yeah. So they started talking back in March.
Yeah.
In this case, we can see a solid backlog of work that will take this business well into the fall and likely next spring. So that gives the buyer some comfort that the earnings will be there at least into the first part of 2021.
Yeah, it's interesting. We have a sporting goods manufacturer distributor, and as you know, I mean, it's hard to find a bike, a canoe, you can't find any of this sort of outdoor recreational stuff. And this guy's business it's 5 times. The bottom line is now 5 times what it was pre-COVID, and rightfully so. He wants to take advantage of this, but no buyer wants to pay for what may be a blip, a temporary blip. And so we're gonna have a hard time reaching, valuation metrics there that are going to make everybody happy.
Yeah. And I think the pandemic has really heightened everyone's awareness on the quality of earnings process. So just to remind everyone, the primary objective of a quality of earnings exercise is to assess the sustainability and accuracy of a company's historical earnings, as well as at the same time, assess the achievability of future earnings and future cash flows. And the type of stuff that we're doing now because of the coronavirus is the type of work we've always done through a quality of earnings process. So it's quantifying the adjustments, normalizing revenues, normalizing expenses.
Yeah.
But it's really, really brought the process to light.
Yeah, you and I have had this conversation before about QofE and how important that is, especially, from a sell side, before you take your business out to market, get that work done ahead of time. Your team, the buyers are going to have a lot more confidence in your numbers. You're going to get to a much quicker deal that way.
Mm-hmm, mm-hmm. So we've seen, it depends on every unique business and every unique industry, but we've seen adjustments related to obviously lost revenues and profits. We've seen adjustments related to disruptions to the workforce, both positive and negative. There's been severance paid. There's been raises and bonuses paid to keep people employed, especially essential workers. Mm-hmm. We've seen adjustments due to disruptions in the supply chain. We've seen a lot of adjustments related to rent. A lot of sellers have negotiated rent abatements with their landlords. So it's important to make sure that the monthly P&Ls are burdened with the right rent expense, even though we may not be paying them currently.
Yeah.
So it's a wide range of I guess, coronavirus related adjustments when we're evaluating a company's EBITDA.
So I think, I know we want to get to PPP. So to put a bow on this and tell me if you have anything else to add, I think the advice to everybody listening is, we're not back to recovery. We're not at recovery yet. And so, being able to, nail a valuation is going to be really hard depending on how hard hit your business was. And so you may have to wait this out for a recovery or to get more guidance and see what the future looks like before you think about taking your business to market.
Agreed.
Yeah. All right. So let's move over to PPP. That's a hot topic. So many questions about how you should be handling PPP, what forgiveness looks like, how you should be carrying it on your books. Why don't we start with, what are you seeing at a high level with PPP and what should people be thinking about?
Sure. I think there's two big topics as it relates to the PPP in connection with a merger or acquisition. The first is getting a handle on how a seller may be accounting for the proceeds from their PPP loan. So what we've seen, sellers are typically accounting for their proceeds in one of three ways. The first is recognizing those proceeds into income at inception of the loan for the amount of expected forgiveness. So now that the SBA has extended the covered period for eligible expenses, this is typically 100% of the loan proceeds for most borrowers. So clearly from a buyer's perspective, we would look to exclude this income in a quality of earnings analysis. The second way a borrower has been treating the proceeds is to amortize the expected forgiveness into income as the related expenses are paid. So, for example, if they received their PPP loan proceeds in April of 2020 and then started incurring payroll and rent expenses in April, May, and June to use up their proceeds, they would amortize the expected forgiveness against those expenses in the period. So they'd report reduced compensation expense and reduced occupancy expense in the month of April, May, and June. Again, from a buyer's perspective, we look to normalize the compensation and rent expense to actual to make sure each month's P&L is fully burdened with actual labor and rent. Mm-hmm. And then the last way we've seen borrowers treat their PPP proceeds is to just record the full amount as debt on the balance sheet and not recognize any P&L effect until such time the loan is formally forgiven.
Got it.
So the bottom line is a buyer needs to understand how the seller has been accounting for their PPP proceeds and how the P&L has been impacted.
Got it. So, the obvious questions that are coming up in the world that you and I live in, which is M&A, is, somebody's taken the loan and maybe you're in the middle of a transaction while the PPP is being drawn down, or it's been drawn down and forgiveness hasn't been given. What should the parties be thinking about and doing as they're contemplating closing on a transaction? I know those are two very different scenarios.
Sure. It's becoming a more and more common issue. And just as you're dealing with it on a daily basis, we are as well. It's more common now that the SBA has extended that covered period to spend the proceeds on qualified expenses from 8 weeks to 24 weeks. In addition, once the funds have been spent on the qualified expenses, the borrower has 10 months to apply for forgiveness. And then the lender has 60 days to approve the forgiveness. And then the SBA has another 90 days to approve the forgiveness on the SBA's end. So we could realistically be well into 2021 before these PPP loans are formally forgiven. Yeah. So when we look at a transaction, these loans can still be outstanding for some time, and there's a lot of variables that need to be addressed. So
what happens if you're in a situation where you haven't completed drawing down on your PPP? You're in the middle of a transaction, the PPP loan proceeds have not been fully drawn down, and you're contemplating a transaction. Let's say it's an asset transaction. Mm-hmm. what do you do in that scenario, since the loan is still outstanding and there's going to be an outstanding amount that's not going to transfer?
Sure. So the biggest issue is getting the buyer and seller to get on the same page on how they're going to treat the outstanding loan. So in the most basic sense, if the buyer and seller's intent is to treat the proceeds as a debt that will be outstanding for some period of time and never forgiven, there would presumably be a purchase price reduction, just like any other debt that would be in a cash-free, debt-free transaction.
Mm-hmm.
Alternatively, if the buyer and seller's intent is to apply for forgiveness, or if the seller has already applied for forgiveness and yet to receive formal approval, then presumably there would be no reduction in purchase price. Another issue is if the seller has yet to use all the proceeds on qualified expenses. In this case, the buyer will likely request that some cash needs to remain in the business to either A, satisfy the unforgiven portion of the loan, or B, be available to continue to fund eligible expenses post-close.
Yeah.
So, unique to an asset sale, there's a couple, I guess, considerations. In an asset sale, the seller typically ceases to exist as a business subsequent to the transaction. And if the seller has not applied for forgiveness, their employee count will go to zero, which could significantly impair forgiveness. We've seen this play out in real life, and one of the workarounds may be the use of a transition services agreement, whereby the seller continues to employ the individuals and get reimbursed by the buyer, which will allow the seller to reach full forgiveness on the PPP. This may be a last resort because I think there is, a lot of other employment issues related to using a transition services agreement. But it could be an issue where the seller is going to cease to exist subsequent to the transaction.
Is there a situation where if it's an asset sale, maybe if there's an unused portion, the owner then has to put that amount in escrow to be paid back to the SBA, and at closing that check is cut on behalf of the seller, so the buyer knows that that liability isn't sitting out there. The only thing that's sitting out there is that portion that was used that forgiveness is going to be asked for.
Yeah, we've seen that money go into escrow, and we're also seeing those unforgiven balances be repaid at closing, which will be treated just like any other debt at closing. Now, there are some mechanics involved with the seller's actual loan and loan document itself. So typically these PPP loan docs require the lender and the SBA to consent to a change in control or sale of assets of the borrower. And if that consent's not obtained, the change in control event could result in loan default and require either immediate repayment or could impair the forgiveness.
Yeah. So word of caution there is you got to get your lender involved early in the process so you understand how they're going to view this and what the implications are.
Absolutely. And we think that SBA approval or SBA consent of transfer of that loan is going to take some time because they're very quickly going to be inundated with companies applying for forgiveness.
Sure. Tad, have you seen any situations where the banks are allowing a transfer of that obligation?
Yeah, we are. We are working on several transactions that have been approved by the first lien lender, and we're waiting for approval from the SBA.
So it does have to go to the SBA for their approval as well.
It will, because
even if
they're the ultimate guarantor.
Even if the bank is a preferred lender, it still has to go to the SBA.
I believe so.
Wow. So it's got to be adding time to the process. Yes.
So like you mentioned, you talk to your lender, sooner rather than later if we're contemplating a transaction.
Yeah.
In a stock transaction, if the loan has not yet been formally forgiven, a buyer may request a separate escrow in the amount of the PPP amount expected to be forgiven. So the buyer wants protection in case the lender or SBA doesn't approve the application for forgiveness. And this has been, and I think will continue to be, a sticking point between buyers and sellers, especially those sellers who had significant PPP loans. If this is the case, the seller may want some protections too. So if there's a significant amount sitting in escrow pending final approval of forgiveness, the seller may want to negotiate that they want to control the PPP forgiveness application.
Sure.
And not rely on the buyer to do that. Or if the seller's not spent all of the proceeds as of the date of closing, the seller may want to contractually limit the buyer's use of the remaining amount of qualified expenses.
Yeah.
To make sure that the proceeds are used on eligible expenses and they maximize the forgiveness.
Yeah, I think it's a great point because, if in a stock sale, you no longer control what happens, right? And now you're relying on the buyer to, process the forms, process them properly, timely. And if your money's sitting in escrow, you're beholden to what they do. So the sellers do have to think about that carefully.
Absolutely. Another word of caution for stock transactions, and this could be a big one for some time actually. So in a stock transaction, the buyer typically inherits all liabilities, whether they're known or unknown, whether they're disclosed or undisclosed, that exist at the time of sale. As it relates to the PPP, there could be a potential liability lingering out there long after the PPP loan's been forgiven. So, let's fast forward 12 months from now, and the seller has applied for forgiveness, received approval, taken the liability off their books. Recall that the borrower had to obtain the loan and use the proceeds in accordance with the program. Mm-hmm. And the SBA has said that they reserve the right to review any application for forgiveness at any time. Mm. And this could include after initial forgiveness. Mm. So there's some misconception that the SBA can only review loans over $2 million. That's not true. Loans over $2 million will automatically be audited by the SBA, but at the same time, the SBA reserves the right to review any loan.
And so, Chad, if I understand correctly, that audit may come after loan forgiveness was given by the SBA.
Correct. So I think it's important for a buyer to consider if a seller has had a PPP loan at any time, whether it's still outstanding or not, that they should vet that the program requirements were met. So, and a buyer can perform some diligence on the seller's process for applying for the loan, the related forgiveness, the eligibility for the amount, use of the proceeds, all the certifications, et cetera.
Yeah.
And we expect
having a field day with this on the survival periods and the indemnifications and reps and warranties. I mean, it's wow.
Absolutely. And it'll be interesting to see how reps and warranties and insurance covers the forgiveness of a PPP loan and whether that's a carve out or not. And like you said, there needs to be some reps and warranties in purchase agreements to protect the buyer.
Yeah. Wow. I didn't know that the audit could come after your loan has been forgiven. But if that's the case, you're right. I mean, this could drag out. Who knows how backlogged they're going to be? This could drag out for years.
Absolutely.
Any sense for how many or what percentage of the loans, PPP loans, were over $2 million?
I know there are stats out there. I don't know them off the top of my head.
Yeah.
But for sure, I think it's very few. I want to say less than 10% of the loans. Okay. Were over 2 million.
Yeah. Which tells me that they're going to dip below the $2 million threshold if it's less than 10%. So even though they've thrown out that benchmark, be prepared.
Absolutely.
Anything else that you think would be important for folks to know about PPP?
Well, I just think it's important that, if you're a buyer or a seller contemplating a transaction to consult with all your advisors, whether it's your attorney, your accountant, your intermediary, your lender, to make sure the PPP loan is properly addressed. Both in the economics of a transaction, but also in the purchase agreement.
Yeah, the protections and the rollbacks and the clawbacks or whatever.
Absolutely.
Yeah, this is a topic that's not going away. We're gonna be talking about this for a while, I feel.
Yeah, I would love to do an update at some point when we've been through the process a couple of times. This is new to everyone, so it'll be great to get some transactions under our belt with some
we
hairy
have our
PPP
first
issues.
deal closing next week that had a PPP in it, and it was fully used. The bank has acknowledged forgiveness, but like you said, that isn't a panacea. So,
yeah, it'll be interesting to see how it plays out.
Yeah. So, Tad, if folks want to get in touch with you, they have questions about either Q of E in this COVID environment or PPP, how could they reach you?
I can be reached at my email, trender, RENDER, at millercooper.com, or 847-205-5000.
I always appreciate you being here. Your wealth of knowledge, your time is, I know, very valuable, and really appreciate you being here with us.
Well, we've enjoyed working with you, Domenic, and your whole team at Sun Acquisitions on many deals over the years.
Thank you. Appreciate that. All right. We'll talk to you soon.
Thank you. Take care.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.